we've been discussing global markets as they've rebounded in the past session on Wall Street at least. Can they hold that line? All right, Clifford Bennett joining us from ACY Securities. Clifford, good morning to you. Great to have another chat. All right, so we were talking a week or two back, you'd call the top for equities. You're maintaining that line. What are you seeing now that is influencing your decision making?
Good morning. Good morning to both of you. Yes, great to be on your show twice in one morning, I must say. Thank you very much, Andrew. Sorry, my apology for that interruption. It was a hardware issue. Okay, with equity markets, it's a very good rally we saw yesterday. And it's the first rally really that's caught my eye as something that could be a little bit more sustainable than just a momentary bounce in what has been a very aggressive sell-off over the last 2 weeks. And we did on your show, Andrew, I said at the time, I'd helped to make you famous. You're already very famous by calling the ultimate top in US equities within the last 3 hours just before your show. And ever since then, it has been a very volatile but steady move to the downside. And I think really that's going to be the character going forward. However, this momentary focus of market sentiment on Omicron, ignoring all the background difficult economic factors, means that when there is good news about Omicron, we can see significant rallies. This could generate a long period of consolidation here around current levels in US markets before, I think, still an eventual down leg. But it's a little bit less clear now than it was 2 weeks ago that there is immediate downside risk to US stocks. I still wouldn't be totally rushing in to buy the dip, if you like, on a long-term basis, because I still feel that the damage done by the pandemic is of a longer lasting character than most people are assessing. I still feel that supply chain disruption will be ongoing and a sort of roller coaster event for some time to come, as well as inflation being well and truly out of the bag now. I'm calling it wildcat inflation. And that will be driving, and we forecast, 6 months ago that the Fed would be unwinding bond buying and raising rates far more quickly than it itself thought, that the RBA would be raising rates in 2022, even though it didn't think so at the time. And we're certainly seeing that shift towards our view that they would be forced to change their then view by the realities that would come into play. That is a slower economic growth outlook, a more moderate reopening phase for Australia, for instance. I mean, everyone was forecasting a stock market boom for the reopening of Australia. We've been going down for 4 months in the AUS 200, and we've been sideways for 6 months. So I'm not sure why people are still so excited about the Australian market. It's been a bear trend for 4 months now. We are seeing good rallies, and the rallies tend to attract more headline attention, but the declines are still there as well, and that's why we're lower. Much lower than we were 4 months ago. So I think there's a lot of real fundamental pressures for being cautious, all equity markets around the world, and you combine that with their extreme valuations, it's not a sustainable mix, I think.
And we'll keep that in mind. Of course, the RBA is later this afternoon, perhaps unlike the Fed, which sort of feels obligated to keep those asset prices spinning indefinitely. There's no such pressure here from the RBA. I mean, I'd love that small surprise that they just take away the QE buying. Buying does nothing for borrowing rates, as you know. It was brought in to keep the Aussie dollar down. Look where the Aussie dollar is.
Well, you're quite right. I mean, the bond buying, it was follow the leader. The RBA has been doing it for quite some time. Let's face it, we don't have one of the most talented central banks in the world. And I'm not sure why everyone pays them such regard. They're not highly regarded overseas, and I think we should be a little bit more questionable of their performance. Bond buying should never have been instituted in the first place. There was definitely no need for it. It was only done because the Fed had done it, and the RBA likes to see itself as another Fed. And interest rates are at ridiculous levels in Australia. I'm not foreseeing a strong economy. I'm seeing a below trend growth economy, but even below trend growth does not justify interest rates at all-time crisis levels. So you're quite right. What the RBA should do today is immediately stop all bond buying. It doesn't have to taper it, just stop it. And it should probably raise rates today as well, if it was an intelligent central bank. I mean, lots of other central banks in the world have been raising rates for months. Mexico, South Korea, various places around the world because they understand we need to unwind the crisis settings. They understand inflation is a real force. And sure, it's not showing up in the numbers in Australia yet as dramatically as it is in the United States, but it may only be a matter of time, particularly with the currency weaker, as one of your previous commentators mentioned. But I do think we should be returning to still some stimulus in the interest rate setting, but by no means this historic near 0.1% bond buying program.
Yeah,
I don't think the RBA will do any of that because I don't think they're smart enough to.
Yeah, I think we would all fall over if we saw any movement on rates today.
I was talking about what an intelligent central bank should do. So
I'm not casting dispersions. All right, so Clifford, just as far as the currency is concerned, so the Aussie's sitting at about 70.5 US cents. I know you called this a few months ago as to where it was going to be. What levels are you seeing from here on, particularly, I guess, when you look at where the US dollar is going?
Yeah, I don't mean to favour you too much, Andrew, but again, that was with you on an ausbis show. The very first time I said that, Aussie was at 77.45 and I said the target was 70 cents. So maybe you're the good luck charm, but more people should go on your show. But I think it's going to have a bit of a bounce now. It's been a one-way street for a while. Markets, do oscillate. The US dollar has been very strong, but it might have a bit of consolidation here. So there might be an opening for the Australian dollar to bounce a little bit, particularly if the RBA today says something along the lines of we have to reconsider a little bit. That's the most we could expect from the RBA today. If they say something along the lines of we need to reconsider, we might be adjusting policy sooner than we previously thought, then that would drive a bit of an Australian dollar rally. Overall, in the big picture sense, I think we have to highlight that there is risk now. Our 70-cent target's been achieved, but I recently came out with a fresh forecast where I do think there is risk to 65 cents for the Australian dollar, and that's in 2022. In 2023, if things don't turn around for Australia, because remember, we are in a declining trade situation now. If things don't turn around for Australia and the domestic economy is weaker than most people appreciate fundamentally. If we don't turn around now, then the Australian dollar perhaps has risk to 58 cents in 2023.
58.
Yeah, well, there goes that US holiday.
Well, we have been there twice before, so it's not a new event. But that's the risk scenario. I think a fall to 65 cents is certainly on the table for consideration.